Hello, everyone. This is Joseph Trevisani with the resumption of the Market Directions interviews. Today, we are fortunate to have an old friend and colleague of mine and one of the best known analysts and writers in foreign exchange and related fields, James Chen. Mr. Chen, it's very nice to see you again, as always.
Great seeing you as well, Joseph. Thank you very much for having me on again.
My pleasure. And it's always interesting now we're sitting here in front of the blank walls, each of us in our home office.
Yes.
The digital revolution continues apace.
Exactly.
We're in a curious, I think, spot in the currency markets right now and markets in general. But I'm going to start with the currency markets with the sort of the background that almost all markets, commodities, currencies, credit, and stocks, except for stocks, are trendless right now. They haven't really been doing very much. The stock market, of course, led by the market in the United States, is booming. We can talk about the reasons for that in a minute. But let's talk about the currency markets first. We had, over the past year, until about 10 weeks ago, a pretty strong trend against the dollar.
Yes.
It was true in the euro. It was certainly true in the yen. It was stronger perhaps in the euro and the euro and the yen than it was in the sterling, sterling being a bit of an exception because of Brexit. It seems for the past 10 weeks that has stalled. What do you make of that at the point where the Fed is going to resume, most likely, its rate increases?
Well, that's a great question, Joseph. I think that there are a lot of reasons that that downtrend has really started to rebound and recover, and I think most of it is because during this year, we saw that huge downtrend as you just mentioned with the not only the euro dollar, the uptrend for euro dollar, but also for the dollar index. We saw that it hit multi-year lows. And I think a lot of that was due to, skepticism over U.S. fiscal policy. But mostly, during the year, we had a lot of speculation that the Fed might have been becoming more dovish. And I think a lot of that has changed towards, most recently, where, we see, for example, with the December, a speculated December rate hike, the market is looking at over 90% last I checked for expectations for a rate hike. So, I think the dollar was very oversold, generally speaking, this year, and I think it was very due for a bounce, a rebound, if not a recovery. And I think going forward, I'm actually rather dollar bullish because of first of all, the Fed has been more hawkish as of late, and also because when Janet, I think we talked about this before, where Janet Yellen, her term expires in February, and I think more likely than not, if she does not keep her position, if she is not renominated, we're going to have more likely than not, we're going to have a more hawkish chair of the Fed going forward. So I think the tailwind for the dollar might be there going forward.
I think you're right. One of the things that I find interesting at the current moment where we are is the fact that the dollar is that the euro and the sterling have held up as well as they have. Yes. If you look at some of the developments, you can put one side on the United States where the stock market is an indicator. It may not be the only indicator, but it is certainly an indicator of something. And it's not only an indicator of a lack of alternatives where to invest, because that's been true for the past decade pretty much. There's nothing new in the situation right now. In fact, if you look at it, the pending rate increases, which are going to continue, we assume, would be returning the balance a bit towards the bond market. So we have the stock market as an indicator. U.S. economy, once again, doing better than almost all the other economies in the world. This is a situation we've had before. But that's on the U.S. side. On the European side, we have the political developments, which we have seen cascading in the past couple of weeks, actually the past couple of months. And we mentioned them earlier. We have the German election, the lowest vote for the Social Democrats since World War II, a definite slap in the face for Angela Merkel, and if not her economic policies, certainly her immigration policies. We have the Spain Catalonia. What do we call it? A contretemps? I'm not sure exactly what it is. It doesn't quite seem to be a rebellion. I don't note that the Catalonians have any military. So there's definitely a dispute there, which threatens, you would think, the stability of Europe. We had the Macron's election in France, where although he has said he's very much a supporter of the EU, some of his other comments over the past number of weeks have been quite different in their tone as far as the EU's unification policies. And then, most recently, we had the Austrian vote. So these are political trends, and it's clearly a trend that the EU is going to have to deal with. And as far as I can tell, nobody's paying any attention to it, at least on the EU level. This should be damaging the euro. It's not. So
yes. And I agree with you. And, you know, there's something very peculiar going on, not just with the euro, but as you mentioned with stocks. I mean, the market complacency here is just phenomenal. And, you know, I guess we could say the same about the euro. You know, we do have all these geopolitical risks going on. At the same time, though, I think there's a lot of speculation, at least with respect to the euro, in terms of the ECB possibly tapering the QE program, and that could have something to do with some support for the euro at this point. But yeah, no doubt, you know, what you're talking about is is very true. We have all these geopolitical risks, and yet the euro remains supported, and that can be the same thing. The same could be said about stocks. And if we look at the U.S. stock market, which it's just incredible how this trend just continues to the upside, despite even risks from North Korea, for example. So geopolitical risks are not playing a huge role right now in bringing down markets, and that at some point that's probably going to change. But I don't want to be the person to call the top on stocks. At least I've tried before.
As we know, trying to call tops and bottoms is probably the least most profitable way.
Exactly.
Trying to trade. I mean, it never works. Every once in a while you're
exactly.
right, but all the other times you're wrong, and it never works that way.
Sure.
I look at the stock market, and at some point in many rallies, and certainly in stocks, where you have a greater participation, a wider participation of individuals, lots of small investors and medium-sized investors, not just institutions, not a professional market, the way in currencies, the trends are largely set by the professionals. They're not really set by individual investors, individual traders operating from our homes or wherever we're operating from. So for stocks, you have very much a sense of near the end of rallies. And again, I'm with you. I'm not calling the end of any rally, where everyone who has either not believed in it, less enthusiastic, or an active short, which are usually a professional, gives up because they've simply lost too much money.
Sure.
It doesn't mean that the basic trend, I mean, the economy is doing reasonably well, considering its impediments and other things. It's doing reasonably well, but it's hardly doing a world-beating medium right now. It's just coasting along. Yet you have the stock market at this enormously high level. How much of that is the kind of enthusiasm that can also quickly turn to fear?
Yeah, I don't think that a lot. Yes, I think it's more of a lack of fear rather than enthusiasm. I mean, you have people, you have the markets just grinding up, and it's not like a craze going on with investors. I don't think. I think it's more of market complacency, where you take a look at the VIX, for example, the volatility indicator, and it is at it's extremely low, and we haven't had a pop in the an appreciable pop in the VIX for quite some time. I mean, we had one during the election last year, the U.S. Presidential election last year. But beyond that, we really haven't seen much. So I think it is mostly not just unbridled buying, but more so a lack of fear and a real market complacency that we don't see too often.
Yeah, it's interesting. I'm looking at my other screen here, and the Dow's up 100 points today on.
It's crazy.
Basically, very, very little. Let's turn a little bit to the competing central bank policies.
Sure.
The two primary ones, of course, the ECB and the Fed. In the middle of a very, very, very gradual rate increase policy. It's not acting like a normal rate increase policy. Normally, when the Fed starts raising rates, the credit markets front run it to, I don't know, 50, 60% of whatever they think the final rate value is going to be, and it gets there in 2 months. We're not seeing any of that right now. You look at the 10-year, you see a little of that in the 2-year, in the shorter term. Mm-hmm. But if you look at the 10-year, it's just ghosting along. It's not doing anything. Why do you think it is that the credit markets, which, as Bill Clinton's old remark was, when I come back, no, James Carville, when I come back, I'm dating myself, of course. When I come back, I want to come back as the credit markets. Why is it now that the credit markets seem to be unwilling to front run Fed policy?
Well, I think it's been very clear that the Fed is being extremely cautious, characteristically so, cautious and not very aggressive, and and every single statement that's put out by the Fed always includes the words gradual and we're still going to be accommodative, et cetera. Right. So I think it's it is uncharacteristic. Historically speaking, I think that may be one reason for it. So we are going at a very slow rate. And in the meantime, if we take a look at other central banks, there used to be this big policy divergence between the U.S. and between the Fed and other central banks, and that really has changed in the past year or so, where other central banks. You take a look at, for example, the Bank of Canada, which is going to have another policy decision next week, and you see back to back they raised rates over the summer, and last time in September. So it remains to be seen whether that that type of tightening will continue. But at this point, the Fed is far from the most hawkish of the central banks, and that policy divergence has really dissipated as of late.
Yeah, sometimes I wonder, we're in the unusual situation when it comes to Fed policy that we don't have any real idea of what the end game is.
Sure.
In most of post-war history for Fed policy, the revert to the mean. You reverted to the general range of rates that you'd seen before in the business cycle.
Yes.
Right now, we don't really have any idea where, and neither does the Fed. And they've admitted this many times. Even the cautious Ms. Yellen has said so. We don't know exactly where this is going. They don't know where the Fed, if you're looking at a normal 10-year rate, you look at 4.5%, 5%, historically speaking. I don't think anyone out there believes that's where we're going to end up.
Sure.
So maybe that is also an element of this caution on the part, and you're right, of course, that the Fed has been remarkably bureaucratic in this approach. Other central banks, including Mark Carney in the BOE, has been, and former Bank of Canada, as you've noted, and the Canadians themselves, as you've noticed, have been a lot more upfront, I think, about some of the rate conditions. Can this continue, especially, and where I'm leading with this is, if Mr. Trump, as I think he probably will not, President Trump, does not reappoint Ms. Yellen and goes with someone else, perhaps John Taylor, we don't know. And what effect will that have on Fed policy and the dollar?
Well, I think that's that's one of the reasons that I am bullish on the dollar going forward. First of all, we saw this huge downturn this year so far, and we're seeing signs now that we're in a recovery. But with respect to the Fed and the nomination and appointment for next year, we're probably going to get this the news from President Trump any day now. But again, like I mentioned, more likely than not, if we get someone other than Yellen, which is, I agree with you, which is likely the case, then more likely than not, we're going to get someone. Yeah, we're going to get someone more hawkish, and if we do, then then we could see the dollar rise and rebound and recover a lot quicker than it has within the last few weeks, and we could see recovery for the dollar if we get a very hawkish chief in there, a very hawkish head of the Federal Reserve. Now, just a few weeks ago, we saw that the name Kevin Warsh was being bandied about, and essentially his he's seen as a hawk, and with that we saw a pretty good boost for the dollar, and if something like that comes to be where we do have a hawkish head of the Federal Reserve, then we could see the dollar accelerate its move to the upside again, or its recovery.
I agree. I mean, the only real volatility and real action from a volatility point of view over the past 9 months has been from politics.
Yes.
The primary bit was, of course, election night back in November, when we had the greatest volatility we've seen in years. I mean, it was,
sure,
from a trading point of view, it was a lot of fun.
It was.
Politics aside, no comments on that. Let's move a little bit to one of the things that we've been, one of the criteria for setting up currencies and countries is the resource group. Australia, Canada, other countries, New Zealand, whose primary exports and the health of their economy is primarily on resource production.
Yes.
Do you see there any difference? You would think at the moment, if we're looking at a better world economy, and it is slowly getting better, a reasonably better U.S. economy. China participates in this, of course. The two greatest resource users are the United States and China.
Yep.
There is, at least logically, a potential for some pretty serious trend moves on the resource countries to benefit their currencies.
Yes.
Do you think that's something that we can look forward to, and as currency traders can participate in the next, say, 6 months, 6 to 9 months?
Well, yeah, I think in terms of that, the probably the most the most prominent relationships are between, for example, Canada, the Canadian dollar, and crude oil, right, as well as the Australian dollar and gold. But in terms of that, we've seen a lot of those correlations, break down somewhat. I think, recently, at least this year, we've seen those correlations not hold as true as they used to. And in terms of, at least let's talk about the Canadian dollar, a lot of the surge in the Canadian dollar was obviously not due to any, real surge in prices for crude oil, but rather it was based upon the Bank of Canada and the moves that took place there. And so I think in terms of that, yes. Well, for example, going forward, I believe the Canadian dollar should continue, although in the past several weeks it's been pulling back against the U.S. dollar. That's mostly due to the U.S. dollar strength. But in terms of the Canadian dollar, for example, I think those correlations, should continue going forward, although they have taken a back seat to central banks as of late. But going forward, for example, for the Canadian dollar, I'm looking, if we get a recovery in crude oil prices, which could very well be the case, then the Canadian dollar, could continue to run up. And you couple that with the bank policy, central bank policy, I think it's good for the Canadian dollar.
There was an interesting development in the oil market, on which we have, which markets have obsessively focused on oil, because it's one of the biggest, it's certainly the biggest trading commodity.
Sure.
It has been for 20 years now. So you get a lot of participation in it. And it's a huge speculative vehicle, which some of the other commodities is not nearly as much. But you had an interesting development. I mean, you had the head of OPEC, who is a Nigerian, right now. I think it's a 2-year term. Basically saying to the North American shale drillers, hey guys, help us out. This is your market too. And
yes,
of course, there is a point to this, that yes, the US and the North American shale producers have dramatically lowered their profitability factor. I mean, their break-even factor. So what used to be 50 or 60 is probably somewhere around 30 right now. I don't know exactly what the figures are, and there really aren't any set figures. It varies from field to field and with all sorts of variables. Nonetheless, it is considerably lower than the price of oil right now.
yes.
Oh, yes, American shale producers, North American shale workers will benefit if the price goes to 80. But will they benefit more if they simply produce more oil at 50 or 60?
Yes.
So I've always thought that the shale producers in North America have essentially put a cap on oil. And even if we do get a much stronger world economy, it will no longer work as it used to on the price of oil.
Sure.
This also factors back into resource economies, as you said. So do you think that we have seen a real change in pricing for oil?
I absolutely believe so. I think one of the huge developments within the last several years has been the development of the shale oil industry in the U.S. and it's really taken the world by storm. We have so much capacity here in the U.S. that and we talked about the OPEC deal that was put in place. I believe it was last year, the end of last year or the beginning of this year. But essentially, what do they expect the U.S. Producers to do? Do they expect them not to take up the slack for for lowered OPEC oil output? It's impossible. So if there's lowered output from OPEC nations, it's just natural in a market-based economy for these shale producers who have so much capacity to take up the slack, and that's why I completely agree with you. I think they've really put a cap on the price of oil, in terms of the U.S. shale producers, and going forward, that's really changed the game, I believe, in terms of the oil markets, the dynamics of the oil markets going forward.
I agree, and this also leaves out the natural gas fields here in the United States, which are enormous.
Yes.
When you look at leaving out the environmental issues, mainly because I don't think this is the venue for talking about them, but it is true that the only industrial nation which has reduced its greenhouse gas emissions has been the United States by a dramatic amount, I believe 10%. And the reason is because of the substitution of natural gas, which is plentiful and very cheap, for oil and coal primarily. So you have this enormous shift in the basic industrial commodity, which is what oil is. And to get back to some of the central banking questions, that I think is a factor which has been unheralded, not really unheralded, but it's not given enough credit for the great puzzle of the Yellen Fed. Where's the inflation?
Yes, exactly.
Because oil it's not just what you put in your car, as you know, it's the basic industrial commodity. Period.
Yes. Yep.
And that's not going to change. So where's the inflation going to come from? I think the Fed has kind of given up on inflation, but let's see. What do you think?
I think so too. Inflation has always, low inflation or weak inflation has been a concern. For basically holding back not just the Fed but a lot of central banks from raising raising rates, tightening monetary policy. But it's a big question that at this point, you're going to be raising rates regardless of whether the inflation hits your target or not. At this point, so that's where the trend is going. So I think you're right. They're sort of de-emphasizing the inflation aspect of it, which is really the most important aspect of it. But it's being de-emphasized only because they're being pressured to raise rates and tighten policy.
Right. I think they're also being cautious because their equations haven't worked.
Yes.
The monetarist equations that inflation is always and everywhere a monetary phenomenon, leaving aside how you define a monetary phenomenon, has not turned out to be the case. I mean, we both remember when the Fed started doing quantitative easing, it was almost an axiom that this would produce inflation. Well, it simply has not.
That's
so
correct.
We're in history. I mean, hundreds of years of what you can track on prices, and you can do this in some places. You can do it rice prices in Japan, do it prices in China. Stable prices are more the norm than inflation, than the 2% that the Fed seems to almost have a fetish about. I've never quite understood what's so good about 2% inflation and how it benefit to an economy. So how do the central banks adapt to this? This is certainly true of the ECB as well. They don't come out and they say, you know what, we were wrong about inflation. It doesn't matter very much. We're shifting. And we're also wrong about getting inflation. Because if you look at the Fed's predictions for inflation, going back 5 years, you and I would be out of work if we were that bad at predicting future trends.
Sure.
They're always saying, well, you know, in 6 months, or if not, you know, so how is this going to affect the way, I know this is kind of an academic question, it's a little bit of a long question. How do you think this will affect the way central banks view their role in the economy? Because for the past 10 years, they've been enormously interventionist.
Yes.
And it hasn't really worked out exactly the way they thought.
No, and I think that there's a lot of skepticism. The markets are very skeptical about the central banks, especially the Fed, and you know, in terms of what you know, what they set out to do and what they've done. You know, a lot of it, as you mentioned, does not really work. So you know, I think generally, yeah, there's going to continue to be a lot of skepticism. I think going forward, if you're talking on a broader basis. A broader perspective, I think markets are going to be much less dependent upon central bank policy going forward because of this skepticism and the fact that, you know, like you say, nothing really has worked.
Yeah, it's very interesting. I'm getting a question here from, I think through FX Street, so let's address it to you since you are the expert here today. They want to know about the currency pairs, the CNH.
Okay.
So what do you think?
Okay, that's one of the currency pairs that, or the currencies that I don't talk about. I don't analyze. I'm mostly G10. So in terms of that, yeah, I mean, because it's not fully, you know, that's the RMB, the yuan, the Chinese yuan.
Right. That's
the offshore one.
The offshore one, the one you trade in Hong Kong.
Yeah, the Hong Kong one. But you know, generally speaking, you know, it's tough because the Chinese yuan is still, you know, essentially fluctuating within a band against a basket of currencies. It's not completely convertible and floating as of yet. That could change very, very soon. In fact, right now we have the National Communist Party Congress going on in China. Not sure how that's going to affect the RMB, but you know, so far it looks pretty good in terms of what you know, President Xi Jinping is talking about for the future of China, from what I've seen. But you know, in terms of the actual currency impact on the RMB, the Chinese yuan, you know, I can't really address that because I don't really trade that or talk about that much.
Yeah, I agree with you. I mean, from a currency trading point of view, I don't think it's particularly useful to analyze much. I've always looked at the yuan, both of them actually, as an indicator of Chinese policy and the health and the state of the Chinese economy. For that, yes. I think it's a useful barometer. It's one of the best barometers actually for what's actually going on. It looks as if all of the dire, it was interesting, I got a call from Reuters yesterday and they wanted to comment on the fact that President Trump has not declared the Chinese a currency manipulator in the latest Treasury requirement, I think.
Sure. And
my comment was that that's because they aren't. For the moment, they're not. The Chinese yuan has been getting stronger recently, and for the past year and a half and more, for the Treasury's specific criteria, they're simply not currency manipulators. Of course, sure. you fit that into the geopolitical situation in North Asia, and it's very evident why one meaning the situation in North Korea, is far more important than whatever the Chinese are doing with their economy. But let me ask you one more question before we go here.
Sure.
We're getting towards the end. The ECB has been I won't quite say slow learner, but as some people used to know, to say, the fast follower in central bank policy. Over the past decade, it's been the Fed, which has gone out of its way to be active and to take measures that have certainly worked in the sense that the U.S. didn't fall into recession again, and all of the terrible things that could have happened. Sometimes I think the best Fed defense is, well, things could have been worse. Okay, be that as it may.
Yep.
The ECB has adopted all of the policies of the Fed, even though they were dead set against them when the Bundesbank had much more influence, which seems to have waned. Will the ECB continue and follow right down the Fed's route where because the European economy is not doing nearly as well as the U.S., where the Fed is now restricting credit to some degree and raising rates? You think the ECB is going to go there, and what might be the time frame on it?
That's a good question. I can't predict the time frame on it, but I do think they will be following the footsteps of the Fed, much as many other central banks have. Now, in terms of the ECB, the big question is whether or when they're going to start tapering their asset purchases. And of course, the Fed has talked about beginning to do that. So I think they will definitely follow suit. Now, the question is always the time frame, and that will affect the euro. It's basically the time frame. So there was talk a while back about the ECB actually raising interest rates. I don't think that's going to be anytime soon. But generally speaking, yeah, like you said, they are a slow learner, and over time this will happen. But again, the big question is when it will happen, and that time frame will affect the euro going forward.
Jim, if you have time, I have two more questions. Do you have time for it?
Yeah, absolutely.
One is is a question on the British exit from the European Union. The rhetoric out of the negotiations, which aren't even negotiations yet, because the Europeans want the British to agree to pay 60 billion euro before they're even willing to start about terms. The British say, no, we're not going to do that. The markets seem to have very little fear of as I call it, crash out of the European Union, meaning that they simply reach the end date and they have no terms. The countries set up their trade barriers, and that's where we go. One, do you think that's possible? And two, why is the market not paying attention?
Well, I think in terms of Brexit, first of all, I think Theresa May has really lost her mandate. In terms of leading the negotiations. But generally speaking, there's so many unknowns with regard to the Brexit negotiations at this point. I think that's really weighing on the British pound, and you couple that with the Bank of England, I think, will be raising rates sooner rather than later, but it won't be a very aggressive path to tightening. But generally speaking, I think this whole Brexit thing is a very big deal, and it's putting a lot of pressure, and going forward, putting a lot of pressure on on the pound, and especially because there's so many uncertainties involved with the negotiations right now.
Jim, I have a question coming through the chat. Somebody wants to know your opinion on the ZAR.
Okay, the South African rand. Again, I'm mostly a G10 guy. I think you are as well. In terms of the South African rand, yeah, not sure. I mean, if you could shed some light.
I will give you my only opinion on the rand is primarily as a resource currency. It's one that varies a good deal with the price of gold for obvious reasons. When there is turmoil in the world, then you get people interested, and that redounds to the mining interest and everything else in South Africa. I am afraid I'm with you on this. My apologies to Mr. Omdara that I don't have a more concrete opinion. The last question I want to ask is a very general one, and I thank you for staying.
Sure.
It's been an unusual 10 years, both personally for you and I, and also for the world economy in general. It sometimes seems right now, not sometimes, it seems right now that the old style business cycle has been, if not repealed, it's put on sabbatical for a while. I don't believe that that's possible, but I also don't see any indication of anything changing right now. Do you think there's an interplay between these, and I do, of course, between these permanent, semi-permanent, very low rates and the diminution of the business cycle we've seen over the past 6 or 7 years?
Okay. That's a very academic question.
It's also a leading question. Let me rephrase it.
Okay. Go ahead.
There doesn't seem to be a lot of strength to the business cycle right now.
Mm-hmm.
Do we think it's actually been obliviated? I doubt it. What could cause that? And in addition, what could revive it? And it is an academic question, but a little bit less so.
Okay. Yeah, I'm not quite sure what you're asking there, but what could revive the business cycle at this point?
For instance, we haven't seen a recession since 2009. Okay?
Yeah.
It's a very long time for an economy, especially an economy, I'm talking about the US, an economy that has teetered on the edge of very low growth, where you would think that a small blow could push it into recession. It hasn't happened.
Yes.
So the stock market is running with this. Many of the markets are running with this.
Yes.
As after all this time, you can see why. Can you think of any trigger that might actually bring about a decline in economic growth, primarily in the US?
I think the central banks could have a role in this, especially as conditions get tighter and tighter. Monetary policy gets tighter and tighter. But generally, like you said, right now is a very peculiar time. I mean, you look at the markets and how they're reacting. It's just it's not business as usual right now. But like you said, the business cycle is there. What could possibly cause this? I mean, if there's if we get a lot of tightening from the central banks, this could possibly, it could possibly result in something like that. But generally speaking, yeah, we're in different times right now. It seems.
It seems like it does.
We'll see what happens. Yeah, it very much does.
I have one more question. This is it, I promise.
Sure.
On the chat, what is your opinion on why the correlation between the Nikkei and the dollar yen is breaking down?
Yeah, that's a tough one. I saw that question. I'm not sure. It's very hard to say right now. I could say that in terms of the way the equities are reacting and the way currencies are acting, the correlations that traditionally have held true between for example, the stock market and the U.S. dollar, the stock market, the U.S. stock markets and the U.S. dollar, for example, have really not held true as in the past couple of years even. And you talk about the traditional correlation between the dollar yen and Nikkei, as well as with other equity markets. Correlations seem to be going out the window at this point. That's at least what I'm seeing. So. Very hard to tell at this point. It's a very different but very exciting time as well.
I agree with that entirely. I think one of the things we've seen is that this permanent low interest rate policy, which is only now beginning to change, has really damaged many of the correlations, because many of them ran through the credit markets and ran through a front running of the credit cycle. Okay, Mr. Chen, I thank you very much. I will not keep you any longer. It has not only been informative, it has been fun, as it always is.
Yes, absolutely. Appreciate it.
I will talk to you about next week, but thank you very much for attending to this and my questions. I thank FX Street for giving us the facilities to do this. and hopefully we'll see you again very soon. And best wishes for everybody on your side.
You too. Thank you so much, Joseph. And thank you, FX Street. Thanks, guys.
Take care.